Hi guys, welcome again to another lecture. If this is the first time on the channel, welcome aboard. I would recommend that you take a look at our previous lectures. So I started this series from lesson 1. So check out lesson 1. Like I always say, if you don't do that, you're denying yourself a learning opportunity. If you like, you can start with this video, get a feel for some of the stuff we talk about all around market profile. This is a market profile trading course. I have done this over a series of lectures and I will continue to do this into the future. It's going to be a packed lecture series. You're going to learn a lot about market profile. I believe I'm the only place on YouTube currently that offers this kind of opportunity. So if you want to learn about market profile, you want to learn about TPO charts, this is exactly the place to do it. Moving on. Today, we're going to talk about, and by the way, I haven't done a few lectures now just because I haven't been feeling too good. So I needed a bit of a rest, especially from lectures. Obviously, I trade for a living, so unfortunately, I can't necessarily rest from trading unless I'm taking a holiday, in which case I'm not way off the holiday season at the moment for the part of the world I live in. So I'm not really taking a break per se, but I needed a break over the past couple of days. So I've scheduled lectures. Some would be released, but they're slightly older in time in terms of time frame. So it is the 26th of June today, and I'm doing this lecture just to bring everyone up to speed with dates. Well, amazing to have you here. I totally appreciate you guys, as always. Thanks for tuning in, supporting the channel. Continue to do so. I will continue to produce quality lectures on TPO charts and market profile. I did promise the community in my Discord server, link in the description below. It's also flashing on the left-hand side of the screen. So you need to be blind not to see it. Connect on Discord. I post a hell of a lot of stuff there covering lots of fundamental analysis around trading, some of the positions I do, stuff on the profile. So there's additional content there that's going to help you in your journey. So sign up to the Discord. And any questions, you can also DM me directly. If you've got questions on this course, put them in the comments below and I'll answer those questions. Please guys, no spam. All spam gets deleted. Anything that is not necessarily related to questions around what's been taught here, I tend to just delete because I love to sit here and maybe debate someone as to what's right or wrong, or, take spam, sending someone to, some random crypto channel. But truth is, I just don't have time for any of it. I think people are here to learn and they want to learn about trading. So that's what I'm providing them. Anyway, moving on. So today we're going to talk a lot about the initial balance in terms of what I call the opening range. Now you probably heard that term before because it wasn't necessarily coined by me. It's something that's been in the market for a long time. I think for new traders it's just underlooked, and in the context of the profile it's like super relevant. So I think it's a really good time to kind of put that out there and say, this is something you should be looking at. We're going to talk a lot about how we do that, right? And we're also going to look at volume, right? So again, this part of the lecture series is all about execution modeling, right? So I believe now we're somewhere around lecture 18. So we're very deep in, and what we're talking about a lot here is modeling. So in other words, how do we model to get into trades more consistently? One of the reasons that traders struggle, and this is probably the single biggest reason, is they don't have a consistent execution model. I'm not saying obviously people can't trade. Lots of people can trade, and you might find yourself that you can trade. The problem is you just don't have an execution model. So if you're not able to turn a profit, that's what it is. Most people don't, because they really don't know what an execution model should look like. Most people who teach trading will tell you an execution model is, you buy a low or you sell a high and you put your stop here, and then that's it, and you do that consistently. That's not an execution model. what you're basically telling someone or teaching someone is how to take a trade, right? Because that's what's going on. You buy here, you sell there, you put your stop here, you put your target there. But where is the relevance in that point of execution? So that place, where is that relevant place that occurs enough times for it to be even a relevant place? So for example, highs and lows in markets, they occur. That is true. But they don't occur often enough for us to make it a relevant execution model by itself. So I know at some point the market's going to make a high. If someone says if every time the market makes a high, sell that high, then I have to ask a series of questions. So do we mean a high on a 1 hour chart? Do we mean a high on a daily chart? And then now we start to grind it down. And then someone has to think whether they want to sell every time it makes a high on an hourly chart or a daily chart, right? And if you say you want to sell every time it makes a high on a daily chart, then how do you manage the volatility on the daily chart in terms of your risk and capital available to you, right? So you need to be able to develop an execution model in a time frame that's relevant for you, and something like a high or low, whilst you could say occurs quite a bit, but it occurs fractally. And to base your decision making on solely that would make obviously trading quite difficult for you. You're going to find it incredibly hard. So to make things simple, everyone talks about having an execution time frame. Right? And that makes sense because you've got a time frame where you get into trades. But then again, most teachers fall short of explaining to students or traders, depending on the setting they're teaching in, they fail to explain, okay, you've got an execution time frame. What's the relevant thing that takes place on this execution time frame that I should be looking for? Some people say, well, look for a run on stops on that time frame. We've talked about run on stops here in the market profile series, so we understand that when there's a run on stops, it sets you up for a trade, but you still need a fixed point where you get in all the time when this event occurs, because now you've got an execution model, which means that there's a high probability of that specific scenario showing up. There's a high probability that when something happens specific around that scenario, that trade is going to take on volatility, because that's really what it means when we say we're looking for a take profit or a target, is we're looking for the market to expand volatility directionally because of that event occurring. And statistically, on a probability basis, you are going to be profitable if you can identify that. It's a big if, but if you've got the experience and the knowledge to identify it, then you are going to be successful. And that's where a lot of people fall short. So in this lecture, that's exactly what I'm going to show you. It's an example of an execution model. And if you like, you can go back and look through all the other asset classes, currencies, whatever it is, to find and see if that execution model can work for you, right? And if it can, that's something you can implement. Now, this particular execution model can be implemented in different ways. I'm just going to give you 2 examples, and then you can be the judge effectively of what way you prefer, and are there other ways. So you're going to have to do some legwork, but I'm going to give you 2 examples so you have an idea of execution models. What I don't want to do is sit here and give you what one would describe as a trading template and say, oh, do this and you're going to be profitable every time. I don't want to commit myself to that kind of nonsense, because the truth is, even if I told you exactly what to do and I left you to go and do it, 90% of the time, you're not going to be able to do it. You're going to come back to me and you're going to say, oh, I tried doing that thing, it didn't work. Because maybe you're not consistent. Maybe you haven't really ultimately thought it through. And this is what we're going to talk about today. So, awesome stuff. I hope you stay through the video and you really learn and get good value from it. If you don't, thank you for checking in. Whilst I know you're missing out on a learning opportunity, well, it is what it is. I can't make you stay. But if you do decide to stay, I promise you, you're going to take a lot of value from this. But again, if you're new, because again, the way YouTube works is this video hits people sometimes the first time they're seeing me, they don't even know who the hell I am. I'd seriously advise you go back and look through lesson 1 all the way to here from my very small YouTube channel. Right, my YouTube channel is small, it's tiny, because all I ever do here is value, education, making sure people know what they're talking about. I've been in the business for now well over 15 years. I'm a professional trader. I do this for a living. YouTube doesn't like people like me. I'm not an influencer in the sense that I'm not gonna be able to sort of do what some of the other influencers do. I don't have a Ferrari to flash in your face. That's just doesn't make sense to me. Trading is hard as it is. If you manage money, you have a bit of money to manage, you can make pretty much a very, very decent living. If you're an individual trader, you can make a really good living trading individually. You can make more than a couple of grand a month. But the truth of the matter is that, one, you need to invest some capital into this. If you're going to succeed in that way, that's the first thing. Secondly, you have to first be able to make a wage. So in other words, you have to be able to be profitable by yourself. So I know it's hard, but there are a lot of influencers out there who make it look really good, and it's so enticing. And as a consequence, YouTube promotes that more. I am not that, so my channel has grown very slowly, but I've got well over 100, 200 videos on this channel, I believe. I haven't even checked. That will tell you everything about trading. I've got another lecture series called Professional Trader Program, which essentially breaks down trading from start to finish. It's also here on the channel. I've left links on to each playlist. I've put stuff in, like from this video, you can access all of that. But what I'm trying to say to you is that if you're serious about changing your life with trading, and I mean in a really big way, then you want to be able to follow this lecture series from start to finish. I have all the tools you need to do this with Market Profile. If you need access to a Market Profile, let me know. You can do that via the Discord. It will cost you money, but I assure you it's not going to cost you as much money as it would cost you if you went with any of the traditional options, whether that's TradingView, Sierra Charts, or you went with any other platform that offers this. You're going to spend some money. I give you a lifetime with this particular TPO Market Profile. You can segment it. As you can see, what you're seeing on my screen at the moment are hourly profiles. So if we take a look at that, you can see this is an hourly profile. And if I bounce off to the NASDAQ, you can see here, this is daily profile. And if I bounce off to WTI crude, you can see that I'm able to segment this into daily profiles as well. And I can also segment them into weekly, monthly profiles. Whatever segmentation you need, this can do. So it's up there. It was designed around CQG's own TPO chart. So for those who don't know who CQG is, they do a lot of platforms for institutions. So again, it has an inbuilt TPO chart. The only difference is CQG would cost you as a retail trader give or take about $400 a month. And you can have, I think there's an extra $85 for TPO, but you can have everything built in, basically. But that's how we built it. And we built it for MT4 because at the time, MT4 was the most accessible platform to retail. It didn't make sense building it for Ninja or any of the other platforms that were still at that time not as accessible or dealt in specialized products. So we built this for specifically MetaTrader. So people, ordinary traders, ordinary people could get access to this and make money for themselves. So bottom line, I have built this whole thing with you guys in mind. So if you want it, I'll give it to you at an incredibly reasonable cost. Lifetime, you don't have to keep paying for it. It's done and dusted, and it's available for MetaTrader 4. Any questions around it, DM me. Join the Discord server, DM me directly. Whatever works for you. If you want to go to the big boys and pay the $40 a month or whatever it is they charge these days for platforms, absolutely phenomenal. From where I'm sitting, I've used a lot of platforms. Well, fair enough. Kudos to them. But if you just want to trade and make money, you want to avoid that, you want to stick with your initial setup with your current broker and you just need somewhere to get data feed with TPO and you can execute off that, not a problem. I do the same. I don't like spending money for trading. It is a business, so whatever cost I can save, I save. I want all my money up front. Don't care how much I'm making. If I don't have to give you a penny for anything, and that includes data, I won't. Obviously, I trade options. I do a few other things. So unfortunately, I do have to pay for some data. But if I can avoid it where I can, I definitely don't pay for it. All right, awesome stuff. Now on to the lecture. Thank you so much for hearing me out through all of this. Every now and again in the lecture, I will pop around and give you these, what seem like spills, just so we can build some perspective. All right, moving on. So we're going to talk primarily about the opening range, right? And what is the opening range? So the opening range essentially, so we're looking at an hour profile. We've got 5-minute rotations. The opening range essentially is the first 5 minutes of that specific profile, right? Because that's that hour opened and it did its first 5 minutes of a range. Now, why is that opening range important? Is because let's say the market was going to continue lower. If you look at these individual profiles, right, they all have what we call a range or an average true range. So if you look to the right hand side, you can see the range is 38 pips on this profile. The range is 16 on this. The range is 17 on this. The range is 21 on this. The range is 22. The range is 26. And no doubt the range on this is likely to be 26 thereabout, maybe somewhere between 26 and 30. Reason for that is quite simple. If there's high volatility, it is the Chicago Open, so I'm expecting there will be high volatility, so there will be some continuation. I'll explain my reasoning around directional trading when we get to the volume side, but I believe that the market's going to go higher, and if that's going to be the case, we'd expect that this market can at least extend another 12 or so pips, possibly 13, 14 pips, because it's currently done a 12.8 range, right? So, and we're going on past ATR development, right? Of course, we know there are periods where, like for example, lunchtime, where that range was much smaller because there wasn't a lot of trading. If this market does go lower, we always leave room for error. Even if we've got a highly convicted idea that we think the market's going to go up, we're going to leave room for error. So again, if we do go down and we take out, for example, the Chicago low, unlikely, which will be, it's unlikely for us to breach value low on the euro. But let's say we do breach value low, then we would expect this market to continue to cascade to a point, right? So what I'm basically trying to say is that even with a cascade, as we can see through the day, the highest range of the day has been 38 pips. So I'm not expecting, based on the day's volatility, for us to do a much bigger run. And that can be confirmed because obviously, as you can see here, that was 11 prior day, midnight open, right? So for midnight, we can see we had big range here. That was 28. We had 28 again, 28.5 at 0900, which was 7 a.m. So that's pre-London open. And then we can see that market expanded at 9 a.m., which would have been post the London open, and did its highest range. So the chances, of course, that the Chicago is going to do a much bigger run than what we've seen at 9 a.m., I'm not so sure, right? But I know, of course, 9 a.m. didn't have the highest volume of the day. I believe we've exceeded that in the NASDAQ. So the chances are we've got what we call a poor high. So we've got a responsive seller that's pushed this market lower and is now struggling to hold a level because we're seeing more volume on the demand side. But we'll talk about that and how that looks and how we plan and build our execution models around this. Okay, so we're going to talk, like I said, I'm going to give you 2 examples of execution models that you can use in your trading. Okay, fantastic. So I'm glad we're on the same page. So, based on the ATR, it tells me that that's what I can expect. So the opening range is important. It's important because it's that point where the market has to do something. Once we've set the range and we know approximately we can go 30, 26 pips in any direction, then there's an edge there, right? Because one, How do we tackle that? Right, so I'm going to use this as an example, the 9 a.m. Right. Of course, this is not when we would trade. I'm going to use it as an example, and I'll talk to you about what's a repeatable event. I love time because time repeats, right? So I like time as that point or that execution point, and I also like the opening range as that point where that's always going to happen. There's always going to be an opening range, and there's always going to be a 9 o'clock. If one of those two things that don't happen, we have a problem with the world. Forget about trading. If we don't see 9 a.m. happen, like that time disappears, and then we just see 10 a.m. show up, then we know we've lost an hour in time. So we need our head checks, right? So I'm not expecting that to happen. So I'm expecting to see, for example, 9 a.m. or 8 a.m. or NASDAQ open to, I'm expecting to see that every day. So it's a great benchmark for me to think about where I want to trade from, right? Secondly, I also know that regardless of the hour, there will be the first 5 minutes will take place, right? So time's a really good benchmark when we start thinking about repeatable events. So I'm going to use 9 o'clock as an example, right? So this was the opening range, which was A period, and you can see the initial balance is attached to it. We also call it the initial balance, right? You can see that here. And as soon as we traded above the opening range high, right, that's an execution point, right? So that's an execution model. So every time we break the opening range high, I'm going to go long, right? And then my stops are going to go below the opening range low, as an example, right? That's an execution model. So I have an 8.6 pip stop, and I'm looking for, let's say, for example, a 2-to-1 on every trade, which will essentially put this about, including cost covering, say about 17.8 pips to 18 pips, right? And then pretty much I have an exact 2-to-1 net of cost, right? So basically commissions paid, spreads paid, everything's paid at this point, and I'm still 2-to-1 relating my costs, because my cost was 8.6 pips. Had I lost this trade, it would have been 8.6 pips plus costs, right? This is important. Money management, right? Money management 101. I've told you, I'm going to talk to you about money management through this course, so everyone understands money management, right? So I'll be more, instead of losing 8.6 pips, I'll be losing more like 10 pips. So ideally, I want to factor that in too. And that means that I might want to push this for at least 20 pips. That should allow me to cover cost on the downside. So now I have a very good risk to reward. Now I'm sure a lot of you've been running for your stats. You might have seen things like your profit factor. You might have seen things like your average win and average loss, right? And you probably notice that most of the time you're failing to achieve. So let's say you are 2-to-1 on all your trades, but you're failing to achieve what will be a complete and exact 2-to-1. Instead, you're getting more like 1.8-to-1 or 1.7-to-1. That's because of those little cost impacts. So factor them in if you want an exact 2-to-1. And if you're in a market that can't deliver that kind of range, in order to get you in a position where you need to be, you need to step away and find a different market that can do that. I believe I have a video on the channel explaining how you pick a market, and it's a lot to do with inflation and obviously how that market outperforms the dollar, as a magnitude of inflation, right? So again, I've got a video around YouTube that covers exactly that. I think you can find that I've got a series which is just about, all these little snap kind of things that people don't think about, when it comes to trading. So just check out the channel. There are a couple of playlists there that you can look at. Again, let's run the same example. I'm just going to now take the 8 a.m. the London Open. Let's say we wanted to get long on the London Open, right? Or we wanted to take a position. Again, if we trade below the opening range low, we go short. So let's say in this scenario, right, we went short. And I can zoom in because I know sometimes this stuff can be small. That's the beauty about this profile. You can zoom in, adjust the scale. It's independent. It only references the time scale. It doesn't reference the date scale. That's why you have a chart panel, which gives you any information you want to know. So 10 o'clock in Europe is 8 a.m. in London, right? And you've got all the examples with it. Then you've got all the information you need. So right here, we can evidently see that we went lower. We put a tick lower, and let's say you went short. stops above the high, market comes against you. Now, a good execution model will know how to flatten a trade. So for example, if I'm short and the market comes against me long, above the opening range high, I want to be long. So I'm essentially 2 trades per profile session. And I'm using the opening range as a benchmark, because guess what? If it goes low and it comes back, then remember, we're still governed by range, right? This entire profile still did 22 pips. The opening range itself, or the balance, we have that information here, is IB range 6.7, right? So we've got approximately 6.7 pips. Right, we're going to say 7 pips because obviously we have to factor in where we get in. So above the high would be about 7 pips. So we've got about 7 pips here. So really, we still have another 14 pips. The market can extend low to high, of course, relative to where we started for the day. Right, so we have an opening A period, 7 pip range. If we take that into consideration, we should be able to get at least 2 more 7 pips either side of that, right? And that should make up to the typical range. So if I'm short and the market goes against me, then I know that, well, I should be at least able to flatten the trade at about 9 pips, right? Because obviously it will take me 9 pips to flatten the trade, because again, I had 7.1. At 9 pips, I think I've covered this trade, or let's say 10 pips even, I've covered the trade. And that allows me to flatten the trade, right, for 0 for this particular profile, right? And then I can move on to the next profile and say, well, since I've done 10 a.m. and I haven't got that range extension, I'm going to start to execute at 11 a.m. I'm not going to complicate the execution model. It could be that you come in at 10 and you hold through 11 and use the 10, or let's say 8 a.m. London, as your overall, that balance as your overall loss place. What do I mean? Let me explain a little further. So let's say I got in the trade on the other side, right? And I'm going for a flat for the day, but I've decided that I'm not going to do that. I'm going to hold this because I think this market's going to continue to go higher over subsequent days. There's an inherent risk to that, is because if it doesn't do that on the session, it could come down and trade out below the opening range, and then you can lose your position, right? But again, you could make that an option, is that as soon as we get to potentially what one would consider to be a break even, then I'm going to cover the trade, so roll the stop to break even, right? And if it comes back, I'll be hit for break even, and if it retraces and goes under the opening range low, then it's done, right? There's not much I can do. If it recovers the opening range, I'll come back in on the long side. So you can tweak your model. So you have, but the point I'm trying to make is that this will repeat every day, right? So we're going to get this on every session. So this is a more faster turnaround. So if you wanted to trade like more or less every hour, or you're like more very deep sort of intraday, almost scalper, then this is a good way to look at it, right? Is because I can go short, flatten the trade on the hour if it doesn't work, and then sit tight. I'll drive into the next hour. On the next hour, I will open again, and then I'll go long and look for a cover. So on a day like this, just between 8 a.m. and 9 a.m., right, on an expanding day, you already were able to make, right, because this would have been a net zero, and at this point, you'll be able to get your target, which is about 20 ticks. So even if you're working this around the standard lot, you're still looking at $200 that you've netted on that day. Do that 3 days in a week, that's $600 for the week. For some people, that's already that's a low wage paycheck, right? If you can do that, then it's a question of scale, right? Then you can do that obviously for a lot more money. The other thing that happens when you do it this way is you minimize your drawdown. You don't draw down as much because you've got a cover, right? So you're always willing to cover the trade in a specific direction. Now, of course, there are going to be days like we're seeing right now. So let's zoom out again, where we enter the Chicago. I think this is going to go up. But again, you can see we've traded both sides at a balance. So on days, for example, where we set up the opening range and the balance is wide, and you've got to do your own data on this. This is a 10.5 pip balance. Particularly, we like to be under 10 pips, so 7, 6. These are great kind of balances. If you look through, you can also measure typically what's an IB range. 9.3, 4.8, 7.4, 10.1, and which of these turn out to be successful. So there's different volatility parameters happening on different time frames. So you can see Chicago opened, even though we've got the impression that we're going for the upside, we can see the balance open pretty wide. So for me, you can always say my execution model, if it goes short, and we're going to talk about this in a minute, and I've got volume on my side, I'm going to discount this and not take that trade, and I'm going to only take trades that are long. When the balance is too wide, I'm going to trade for at least a third of the balance. So if this breaks out, I'm going to wait for the market to catch bids, and then I'm going to try and get in the trade somewhere around here to minimize my risk. And then I'm going to put my stop at an absolute low, or let's say the value low, right? For example. Now this kind of trade that we're doing means that we can't really take the other side of it. This is purely a directional trade, and we're not looking to flatten it. We're going to work on the prospect that this is going to be a high probability occurrence, right? So we don't need to have any protections because we have another layer of analysis, right? So we can do stuff like that. And what that means is that we can hold under the balance, or maybe even under the low, right? And that will tighten the risk. And then we can say that, well, we're quite comfortable with this sort of 7 pip risk, knowing that these things can do 21.36 on the session, right? But these kind of trades where we put the stop under value low, we're now looking at a multi-session trade, all right? Because we're factoring in that the market's not going to take out value low. There's going to be a lot of support here, the lower third. So we're going to concentrate on the upside, right? And that means that we can start to set targets now over extended sessions. We know that there's going to be a degree of resistance at value high, but we also know that because of the volume underpinning this, we're at least going to drive to value high here. In my opinion, there's a good chance of taking out the high, right? If that's the case, then that's what we're positioning for, is a move back up to the high, right? This will carry into multiple profiles, different execution model. But what we've used is the initial balance as the get-in place for even the long side, right? Whilst we're discounting the short side, we're still looking at the long side, right? Okay, so let's talk about volume. So why am I taking this perspective? I have this on my professional trader program, and I wasn't going to talk about this at all, but I believe I've started to talk about it in other lecture series, so I'm just going to continue. Right, so there are a couple of times in the day where we're going to get a lot of volatility, and these are major center opens. I think I've said this before. So major center opens are going to be pre-London 7, 8 a.m., right? The reason I say pre-London is because sometimes if there's news going on or traders want to front run the major open, they will get their trades in at 7 o'clock. So what we're going to do is, and that's why I always say to traders, it's important that you are in front of your trading screen at least 2 hours, well, at least an hour before pre-London. So if pre-London is 7 a.m. in London, then you need to be in front of your trading screen at 6 a.m. You don't take any trades, you just want to be there. Because the important thing is, you want to see how 7 a.m. opens. In this case, we opened 7 a.m. and if you look at the volume on my TPO chart, it says it was 3988. That's the volume that took place in this profile. And then if I look at the volume that took place in the next profile, which was 8 a.m. London, that volume was 4592, right? And if I look at what took place at 6 a.m. London, that volume was 1904, considerably lower. And if I look at what took place in Asia, 4 a.m. London, it was 3146. So Asia's highest volume of the day was sitting on this profile. And then we've just opened London at 7 and we've succumbed it. We've traded above the volume in Asia, and then we're closing as well much higher. So we've got a bullish day. We can see bids at the bottom. You can see the stack. we can see a higher close, and let's take a quick look and say if we can see any liquidity being drawn, right? In order to see that, you want to split the deepest profile, and you can see no, there wasn't, but what there was is a trade at a value low. So value low acted as support, and then we had a higher close. So at that point, I'll bet my bottom dollar that we're going to break the high of Asia because we have more demand side volume at all, right? Really simple, right? It's a lesson in itself. I think I've saved a lot of people's lives already as this. If I understand that, then it gives me a higher probability to say that this market's going to continue higher. So now coming into London, let's say I want to trade an initial balance break. Am I going to trade that short with the information I have already? I don't believe I would. I think I would concentrate on any upside breaks using the opening range as my fixed point in time that I want to execute. And because this is going to be constant and repeatable every day, I have an execution model that I now need to test over several days as a forward test, let's say 60 days forward, and I want to look back 60 days back. So I'll have 120 days worth of data as to whether this is a reliable occurrence that at least gives me a 50-50 probability of success. If it does, it means that I can trade it at a 2-to-1 risk reward, and I should make money. There's no question about it, and that's why you need that fixed point in time. If you don't have that, what tends to happen is that you're going to miss execution, second guess yourself. Even if you have a model that says sell every high, there's a high you're going to miss and not sell because you have doubts, right? So if your model's fixed and it works off principles like this, it could be step 1, I check the volume. If there's demand side volume, I prepare to go long. Step 2, I trade long off the initial balance. That's it. Nothing else. Right, so let's split this rotation again. So in this scenario, right, knowing what I know, and I was going to execute, I'm using a 5-minute opening range at 8 London, it breaks the low. Okay, I don't go short because I already know that there's a lot of demand side here and the chances of us breaking the bid stack is quite low, so I won't trade it short. Instead, I'll trade it long if we break above that level. And because I'm looking at a session move, because I've used volume as a reference, instead of hang my stop on the opening range low, since I can see there's a low of day, or a low of session, my bad, I'm going to put my stop below low of session, right? And I'm also factoring in that this could do about 20 pips, and if direction continues, this could do about another 20 pips, right? So that's about 40 pips that I can get based on range, and then my stop is about 9, so that's already a 4-to-1. So I've got a 9 pip stop with a potential to do 40 pips over 2 hours. Well, it's a good risk reward already, but really, since my systems are 50-50, I'm only looking for 2-to-1, right? But again, if I can get 3-to-1, it's great. It is currency. Volatility is not the same like gold or crude oil, so you might not get that. So I'm going to position for that either way. As you can see, we go up, we retest the Asia high, we break down, trade within the balance, and it looks like we even take out some of the liquidity. It might have been hanging around the initial balance low, because there are people who would take just the initial balance. So there will be stops there, and then we get the recovery. Right? And so the moment we close up on I, that's telling us that we've traded under the balance again, done some sweeping, and now we're back closing it above. So again, if you were a trader now that wants to add to their position, money management, you could do at that point, you could kind of level up and say, well, we've closed above, going to add to that position, and then I'll start to maybe roll stops on one of them as we get above the high. Point in case. Or another thing you could do is, so let's close this for a second. So now we're in this trade. You can wait for the next session to open, and you can do that and say, well, on a session high break and initial balance break, I'm going to go long again, and this time I'm going to trail, so I'm going to go long, and then I'm going to have my stop just below the balance low and within the value area, which means that it gives me a good chance that if we trade lower, I'm not going to get taken out. So I've got a slightly tighter move, and then I can roll this stop to risk-free and cover under the fair price. Well, that's great. So now I've got this on the go and I've got this on the go, but I've only got risk on one, right? So now I've got more of a position. And remember, I'm aiming for 40 pips on all, right? So I want to get the whole way. So I'm looking at this as the maximum to 40 ticks, and then this is just the add, right? Could be most likely it will be a smaller size to the initial entry, just because you don't want to pyramid more and more and more as the price gets higher, because now you're going to essentially skew the whole thing. So that's not what we want to do. So in light of that, I can then roll this stop once we get to the level that I'm comfortable with, if I want essentially the risk, or if not, if we've hit some kind of a high and we're coming back, I can cover the trade entirely. Right, done. And then we close out and we're done. So as you can see, there's a lot of ways to manage money when we start thinking of the balance. But what does the balance do? As you're catching on, is it takes away the anxiety. It takes away the not knowing, because you've got this fixed entry point that you're using all the time. And you can do this in different ways, right? But you've got to be careful with initial balance, because I've seen people use an initial balance in the context of Asia, right? They've turned around and they've said, well, the entire Asia range is my balance, right? You have to factor in what's the volatility beyond that. I'll let you think and debate and query the point. Right, so there's another way we can use the initial balance. So when we're dealing with assets, for example, that open or close, and their times are very religious and fixed. So I'm going to use corn as an example, right? So for example, we can say corn at regular trading hours open, which is 2:30 in London, right? We're going to trade the 1 minute opening range. So the first minute, because usually if you're dealing with things like the grains, and I've kind of built this chart, 1 minute, so just so close this, just so that we're using quarter increments. That's what corn ticks in. It ticks in quarter increments, right? And we've got a whole profile here for, I believe this is a profile for day. Let me see what I configured it for. I think so. Yeah, it's a daily 1 minute. So it's for a whole day, right? So each profile is a day. And you can see that obviously that's why the profile's widened out a little bit, because I've essentially put that in here. So let's say I split this. It's going to go all the way across the chart, but I'm only interested in the first couple of minutes on the open. So we can see this was the open. We opened, closed higher, traded around. We broke that high at this point here. Now with commodities, we will always expect a dip back into the opening range. So if we can get back in, right, so we don't have to go on break. We can wait for a dip back, and then we buy with stops below the opening range line. And then we look for extension. This was a 4-point extension in crude versus about a 1.25 point risk. Right? Of course, it doesn't always play out that way. So if you feel you need to get in order to make the run, then get in to make the run. The key decider here was the opening range. In that case, this is a more direct approach to opening range trading, and you'll see this a lot with futures traders, especially people who've got futures experience, is that they are most likely to trade the market that way. And it's also common with stock traders too. A lot of people will, that's why you get a lot of concepts even in small cap trading where they talk about gappers and stocks that gap on the open, or where there's a lot of strategies in the stock market that are built around opening prints. And that's because in these more cleanly delivered markets, unlike maybe currency, you tend to see more activity on the open. Obviously, as participants clock on, algorithms change their behavior, and as a consequence, sometimes the edge gets eroded. But the one thing I say is it's really difficult to erode an edge that is based on an opening print, right? You can really try and shake people out on the opening print. But again, if you know what you're doing and you're using something like a TPO chart, it's going to be really difficult. You're going to be able to hold a trade. So again, let's look at this one here. Same story. We break out the first minute opening range. And when I say minute, everyone's probably thinking that's a 1 minute. Look, guys, markets are fractal, but when you're dealing with something like commodities, 1 minute, it moves slow, right? Because you're not going to get a lot of ticks. As you can see, we ticked in a minute. We did a under 2 point tick on corn, right? Well under 2 points. And on corn, it's $50 a point per contract, right? So we're really looking, when we say 2 points, it's not really a lot. We're talking about $100 per contract. So you need to have at least 10 contracts on the go to feel if this that is an impactful position. So usually if you're futures traders, the grains are really good assets to look at and sort of build your skill set. But again, you can see we dipped slower. And if we're going to get in, so that was the opening range break on F period, a pullback in IJ, you can set yourself up for a trade. Obviously, this was a much bigger move. I think by C period, we've done about 5 points on this with a risk of about 1.25 equally. There's not a lot of a reason to attack this two sides, just because unless you can see clear evidence that we're going to go the other way, it's always good to be directional. Now, I don't have a lot more data because I get a 4-day look back on these, and then that's pretty much it. I need to record that data in real time and keep snapshots. So today, this is an example of a trade. So this is a trade that I'm currently in, and I'll be sure to let you guys know the outcome. But again, you can see that same idea, right? So I'm not telling you to do something that I wouldn't do. That's the point I'm trying to make. You can see we broke it in B period, traded back in C. That will be our position if we can get hold of it. And again, if we're waiting for a deeper pullback, not a problem. But usually we got 1, 2, 3, 4, almost a 4-letter pullback. You should be happy getting in here. That's about 1.5 points. Again, if you're aiming for that 1.25, that was close enough anyway. But I think it would have been more like, you would have been more like 1.5 to be fair, as opposed to 1.25. You probably 1.25 would have been. You would probably nailed it at 1.25, right? But it's all holding it tight. To be honest, if you've seen the move in, this is a good place to be in, and then you're now looking for the downside. Hopefully, by end of day, we can do at least 4 points, which is kind of a good place to be with corneas. You want to see if you can hammer it down to at least 4 points, and then that allows you to get out of the trade with decent profit, risk to reward. If you're close to 4 points, let's say about 3.25, that also puts you in good stead, or even 3.5, that's a good place to be. All right, and let's look at, so I've got a 4-day look back, so we might as well just go across. And if we open this one here, different day, of course, different behavior, but let's analyze it. But again, we've had a pretty decent one. So we opened very tight on the range, broke it. It's only a 4-tick range, so it's a point range. We don't really need to wait for a pullback on this. We had it down in B, C, D. We came back in E, back into the opening range low. That's a good trade to have. To be honest, I would take it on the break of B. Stops above, that's 109. So it's a point risk basically, because it ticks in quarter increments. And then the market runs up for 2.7, ends up closing the day for about 3 points, which would have been more than enough. More than enough. In fact, you should have been considering maybe even a cover into about 2.5 points, or at least a break even, but 3 points would have been perfect, which puts us down here. Again, we don't care what the market does after that. Right. So hopefully this makes sense when we talk about opening range. I really wanted to introduce that because I wanted people to get the idea of execution modeling. Right, this is one execution model. I've just shown you literally one. There are a ton you can employ that will give you a fixed point to get in. I specifically like time because for a beginner, it will really give you the discipline you need. One, to turn up, discipline not to take too many trades because you've fixed yourself to a singular point of entry. Do you know how hard that is to do from a trading point of view? Is the business is linked to gambling, right? So the addictions here are strong. People want to keep hitting the button. So if you can devise a mechanism, even mentally, so you don't behave like that, you're going to kill it, absolutely kill it. Because the idea of expectancy is, can I do something to a coin flip and make a 2-to-1 on every occurrence? That's all the market's asking you to do. It's not asking you to do anything else. Can you make a positive expectancy? Can you create that? And in order to create that, the singular most important thing you need to do is have a fixed point of entry. If you can't have a repeatable fixed point of entry, how on earth are you going to be able to create an expectancy? because you don't even know what the expectancy would be around, right? Or you have too many steps or processes that need to align, but they're not repeatable. So they might, it's like the constellations. It's like, you know, a particular star system coming in line of sight of the Earth every 72 years or something, or a comet. I think what's it called, Halley's Comet, I don't know, comes around every 76 years or something. So that's what that is like when you put so many processes in place. You limit the occurrence, which means that you can't, it will take you too long to have an expectancy to make it a viable system. Trust me, you will get bored yourself if you're trying to do that, because in the end you're going to be like, oh no, I've been doing this for a long time and I'm just bored, I'm waiting for this thing to happen, it doesn't. And then you start to cut corners, and then you start to say, okay, well, I'm not going to wait for this thing to happen anymore, I'm just going to use this. And then you start strategy hopping, and then it goes crazy. Right, so to avoid all of that, find a fixed point of entry. And as you start, that's why I like the profile, is because it gets you out of the head of too much strategy, like, oh, I need this strategy, quote unquote. Instead, you start thinking, I need to develop I need to find repeatable occurrences, and I need to develop an execution model around those repeatable occurrences. And that's less of a strategy, because it means that you can trade all markets the same way, right? Or you can look for nuances and see if there is still an edge using that method. For example, opening ranges, they probably work very well in corn on 1 minute, but try that on the S&P and see your face blown off left, because the algorithms have worked that out years ago. So there's just not enough edge there, right? That's my point. Anyways, moving on. So let's take a step back to the euro just to close this off. So as you can see, we're still trying to push higher despite all the volatility. The market is failing to break and make the downside. So we're still finding some significant support on the demand side. If you split this, you can see it's been really choppy, very indecisive, but either way, I'm still thinking that we're going to push to the upside, right? And we'll see how it plays out in the future. But again, I hope you enjoy this lecture. I'm just trying to cement some principles. So today we talked about volume, and we definitely talked about how we can apply an execution model through the opening range. You're not going to get 100% of your trades right. If you recall of what I just said, you only need 50-50 to be correct. That is it. You need nothing else. 50-50. If you can do this half the number of times you pay, if you do 100 trades, if 50 of them can turn up positively, and of course you've got to factor things like your drawdown. It's not no good if you're getting 30% drawdown, for example. It might be hard to recover. Your system, if it's good, and it's a 50-50, you're probably not going to get a 30% drawdown. You can factor in the Monte Carlo effect, right? And then that's just a question of size. If you feel that you're going to get 7-8 losing trades in a row, then cut your size down so you can measure that into your capital. Can I lose these 7 to 8 trades in a row? And then am I going to make 7 or 8 trades in a row? It goes inversely as well. The chances are, if your system is doing 7 losses in a row and then doing 3 wins, then you need to now think of a higher volatility asset. In fact, I don't think a low volatility asset would ever do that to you. You're really talking about things that can really swing. And if you've got a fixed point execution model, then you're trading something like gold, then you could get 6 or 7 losses. But the truth is that, and because it's really difficult to develop fixed point execution strategies in an asset like gold, right? You know, it's a bit more volatile. But you can do this on a slightly longer time frame to factor in that volatility. So again, it doesn't really matter. You're still going to arrive at the same conclusion, but it means that you're going to aim for a 3-to-1 as opposed to a 2-to-1, because the asset has slightly higher volatility. And I've showed you how you can find an asset that can do that. The S&P, gold, Dow, they can all do this. And that's because most of these assets are outperforming the dollar by 2x. And any asset that is outperforming, the dollar depreciates approximately 10% annually. Gold appreciates approximately 20% annually. So it's appreciating 10% more than the dollar is being devalued. So you're getting the dollar devaluation back plus 10%. And as the dollar threatens to devalue more, the volatility of gold expands, so the gold price goes up as well. Right, so those assets are great to trade because they follow inflation and they're inflation hedges. And that means that as the dollar tries to devalue, then they will go up more exponentially. Currencies are not inflation hedges, but they will increase their value relative to the dollar. So the dollar depreciates, then they will go up in value. But certainly, any dollar depreciation is going to cause assets like equities, the S&P 500, or assets like gold to expand in volatility immensely. And all of these are finite assets as opposed to, say, currencies, which you can just keep printing more and more currency. So even if the dollar's devaluing, the pound can opt to devalue more than the dollar. Of course, the banking zeitgeist is set in a way that that does not tend to happen too often. But if it did, then essentially that would be the overall expectation, is that if the dollar's devaluing, the pound will go up. And that's kind of how that works. So we just want to keep our eye on that for the most part. And that's kind of how we want to go about building our modeling and trading. But remember, we don't have to be right on every single thing. We just need to be right 50% of the time. So again, and if we're wrong, we need to have a plan for our being wrong. Is it a plan based on a stop? Are we going to go for a cover? Or are we going to reverse the trade and reverse our opinion? Because effectively, we've seen something that is changing that perspective. And then we'll go on that. So for example, I'm bullish that we go higher, but let's say Chicago closes and then we break the low of Chicago. Then I'll change my opinion, right? Because I'll say that, well, we've got high volume trade in Chicago. It's not necessarily a high, but the market is going lower below the low of Chicago. But I won't be able to see that till the hour closes. And then I'll change my opinion and then I'll go short with stops above the NASDAQ in Chicago high. So as a good example, all I'll do is if we close and we don't continue and break the Chicago high, and I'm going to go short here. So even if I had established a long position, then my idea would be to change that long position as soon as we take out the low. But I'll endeavor to stay in that position till that's the case. Again, where would I want my stops? Well, then I'm going to put it over value high, the NASDAQ. I think that's a great place for it to go. And then I'll look for a break, because now that would be a big move, big finger in the face of NASDAQ traders. So I would assume that Chicago wants this lower, and then over subsequent days, I'll see a breakdown. So that should put me back to 7 a.m., which was the London low. And that's where I look to exit, because I know there could be a draw on stops at these lows. So I'll probably look to exit about 1672. But we're not there yet. Listen, we've got about 3 minutes to close the session, and then we'll see what happens. But again, if we sell and we don't do that, and we keep breaking higher, then I will position to get long. And for sure, Chicago is now posting 5619, and it's still lower than NASDAQ currently, but it's peaking, and more than likely, we might end up surpassing the NASDAQ. And depending on the broker you're looking at, some of them would already be showing. I would say just take a glance at multiple brokers just to make sure the tick's on point. But what you can also do is you can just go to volumes and add tick volume to the base of the chart, and then just look at whether the volume's higher, just in case the TPO is not recording this too well. So this would have been, check the time frame, make sure it's on 1 hour time frame on the chart, which now it is, and then you can check and see the relevance. So as you can see, we're still a little lower. There we go, now we finally surpassed it. So this is the highest volume so far, and I think that should get reflected here, which it has. And we shall now see where this goes from here. So again, all we need to see in this scenario is a break of the low, and that's pretty much it. It's done and dusted. Right, so you can see that's where all the volume is piling. Again, if we get a break at a high, we'll get massive continuation, and then we go from there. Break at a low, we should look to get in a nutshell. So if we break the low, we start putting new range, then we can get short. Again, we can use the opening range to get on the short side if we want to do that. I'm hoping this makes sense. So having that execution model is important. I don't carry a lot of biases. If you're trading a system like this, you're purely executing based on what you're seeing on the opening range and the volume. That's it. all you need to do is do this 50% of the time correctly. Bob's your uncle. You're nailing it, because you're going to get your expectancy. Awesome stuff, guys. Till the next video. Adios.